This morning I watched an interview titled Younger and Older Canadians Crunched by Housing, Retirement, and Debt. This current state of retirement readiness in Canada presents a pretty significant challenge. And this is basically what they're talking about in this interview. We'll take a deeper dive on it. But basically, they're presenting the challenges, particularly for those nearing retirement and the younger generation, and we'll go through some of the details on that. For the younger generation, the outlook is even more challenging, and we'll talk about that a little bit. And then on the other hand, we have the baby boomer generation, despite being the most indebted in history, has largely benefited from real estate and investing in real estate, and that's basically the gist of it. But let's jump in and we'll go through this. So let's talk about who's there. So Paul's the founder of Generation Squeeze. It's a charitable think and change tank promoting well-being for all generations. He's also a tenured professor at the University of British Columbia. And then we have Laura Tamblin Watts. She's the CEO of CanAge, Canada's National Seniors Advocacy Organization. She's also a fellow Rotarian. Shout out. They shared some really valuable insights that I think is worth exploring and just talking about in today's video. So to start out with some stats here, some of the stats that the host Mercedes shared with us is that 14% of retirees are actually ready for retirement. That leaves a pretty big gap, and then 31% need to rely on CPP and OAS. And then we have 55% need to make and are making lifestyle cuts. And 73% are at financial risk if they require long-term care. That's from a source of Deloitte Canada. So some pretty staggering stats. What does that really mean? So there were some questions asked of Paul, and I'll provide Paul's commentary on this. So Paul, his highlights here talk about two key concerns regarding the financial future of younger demographics. So firstly, his concern expresses the worry about the challenge they're going to face in achieving a comfortable retirement themselves. It points out a significant shift in the economic landscape. The hard work of younger individuals today doesn't yield the same financial rewards as the previous generation. And this is due in part of the rising costs of post-secondary education, which now leads to jobs that, when adjusted for inflation, often pay less than they used to, right? Furthermore, Kershaw is talking about the emphasis and the impact of the current housing market on young people. He notes that dramatically higher housing prices are major barriers, effectively preventing many from becoming homeowners as a result. And young individuals are left with less desirable option of facing the continuously high rising rents, right? So this situation paints a concerning picture for the future of financial stability and retirement prospects for the younger generation. So good points by Paul there. Although I want to add one thing in though. In working with first-time home buyers, I've noticed a significant trend. Younger generations are increasingly well informed about investment strategies. And this is evident by the growing popularity of this group. They're called FIRE. And FIRE basically stands for Financial Independence, Retire Early. And this movement is characterized by a commitment to aggressively saving and investing that's going to enable these individuals to retire much sooner than traditional financial planning would typically allow. And what I'm seeing is a lot of these savvy young adults are effectively utilizing tools like the Home Buyers Plan, First Home Savers accounts, which came out this year, tax-free savings accounts like TFSAs, and they're often able to save up to 20% for a down payment. And it just illustrates, a proactive approach to financial management and home buying. So big difference there. Yes, there are some young folks that are going to be in some trouble, but there's also a huge shift in the younger generation planning for their early retirement. Also, I want to bring up a key point that resonated with me as well that Paul talked about, and that was the changing demographic ratio concerning retirees and working age individuals. So in the past, when baby boomers were younger, there were 7 working age people for every retiree. The boomers contributed their share, expecting similar benefits in their retirement. However, That situation has shifted dramatically, with only 3 working age individuals now supporting each retiree. So to sum this up, this shift places significant economic pressure on the younger generation, impacting their capacity to support the aging population. And this altered demographic balance not only affects the financial stability of retirees, but it also has a broader implication for financial security in the later years of life. Additionally, there's a growing concern that these younger generations might face challenges due to increased government spending, which we're already seeing, which is also going to impact their financial future. So good points there, Paul. And then we're going to move over to Laura. Laura raised a vital point regarding the financial well-being of seniors. She noted that traditional financing measures, such as the poverty index, often paint an inaccurate, rosy picture of seniors' financial health. And these standard metrics are usually tailored to the needs of the middle-aged family of 4 and don't account for expenses that pertain to seniors, such as health care or in-home care or medications, right? And if for those of you who are trying to wrap your head around the CPI, I know we've talked a lot about it lately in the news because it has a huge indicator on inflation. It also is directing where the Bank of Canada is going on whether or not to lower or raise interest rates. So there's that aspect. In addition to those measures as well, many seniors are in financially precarious situations, right? The baby boomer generation in particular has started to accumulate substantial debt, with some members entering retirement still burdened by student and mortgage loans. The financial challenges for this group have been exacerbated by low interest rates in the past, which limited the actual growth of their savings. And now the interest rates are currently really high, which now they face increased living expenses and costs, right? And that weight on their existing debts further complicates things. So good point there, Laura, agree with that. The latest data from Canada's Mortgage and Housing Corporation highlights this as well. You know, we're seeing a huge trend in seniors holding mortgages. You know, between 2017 and 2022, there was an increase from 10% to 13% in the proportion of people over 65 with mortgages. And this demographic now accounts for almost 9% of Canada's total mortgage balance. There was also another survey done by Angus Reid where it says 40% of Canadians are considering delaying retirement due to heavy debt burdens. So consequently, you know, retirees are increasingly dependent on their home equity and government pensions for financial support. You know, data reveals that over 20% of the people in their 60s and 15% of those 70 and above all have outstanding balances on their home equity line of credit, their HELOCs. And the average there is about 100,000 for those age groups. So definitely that's being backed up, that response by Laura. And then Paul responded to Laura's insights, emphasizing the importance of developing financial solutions that are viable across generations. You know, you need kind of a mirrored strategy of also having the national and government budgets aligning with those strategies. So he talked about Laura's view and added to the discussion. So Paul was providing some context around the use of mortgages. So Laura had talked about, more and more people are using mortgages into their retirement. I just backed that up with some stats as well. And what Paul's saying he's seeing is that he's seeing a significant increase in the number of baby boomers entering retirement while still holding mortgage debt. But this trend is largely attributed to their active participation in the real estate market, including refinancing homes and investing in additional properties, is what Paul is saying. And real estate investment has played a major role in their wealth accumulation for that generation. And from my perspective, you know, the real estate market has been a strong vehicle for wealth building, particularly for that baby boomer generation. And the bottom line, think about it like this: you know, if they were, in their early 20s or early 30s and bought a house that was, $40,000, $50,000 here in Hamilton, and we look and fast forward to today, that house could be worth, $800,000 to $1 million. And, it's just not a bad idea. And then we had the host Mercedes highlight, this issue where there's some dual challenges happening where what families are facing, and that is, caring for their children while also supporting aging parents. And this situation often leads to significant financial and emotional strain. And in response, Laura pointed out that due to the increased life expectancies, people are working longer than before. She noted that the traditional retirement age of 65 was set when the average life expectancy was around 67, aligning with the inception of the Canadian Pension Plan, CPP, right? And this plan, if you think about it, was originally designed for retirees to use that support for 2 years after they retired on average. However, we're starting to see the average age extend past their 80s, and for women up to 85. Now, the problem with that is now people are having to go back to work, right? And the issue with having to go back to work is we're going to run into issues like this topic called ageism, and that happens. So you have, organizations out there that are trying to coach corporations to help combat this ageism issue and try to help some of these seniors get back into the workforce. But with, the government of Canada also pushing the Bank of Canada rates up and trying to force us to go into somewhat of a recession. They're looking and wanting to see the unemployment rates go up. It's going to make it even harder for these folks to find a gig, right? So good point by Laura there, and good question by Mercedes. Also, Laura highlighted that there's an additional challenge in the dynamic of caregiving, noting that often it's not the younger but the older individuals who are taking on the role of caregivers. That's creating what we call this sandwich generation effect. And I found an article on this one that discusses that demographic where, typically they're in their middle years. These members of this generation are caught between caring for their aging parents and at the same time raising or financially supporting their own children. So that's causing an issue as well. So Laura also highlighted another issue I want to talk about, and that's, the significant issue in the housing sector affecting seniors. So despite many seniors having built up wealth or equity in their homes, there's a notable scarcity of housing options that cater to their specific needs, right? So the majority of the available rental spaces out there right now are not considering the requirements of older individuals. And this lack of age-friendly housing makes for downsizing and remaining in their communities a bit of a challenge for many seniors. And furthermore to that, those opting to sell their homes often find themselves relocating to more remote areas. This creates a challenge where the move can lead to difficulties in accessing essential services and healthcare. There could be issues with transportation being a primary concern. And Laura also emphasized that the issue extends beyond the mere cost of housing. It also encompasses the broader challenge of ensuring inclusivity for seniors in our communities when it comes around planning and housing development. So good point there by Laura. And then for me over on the mortgage side, in the mortgage industry, so we're seeing in the mortgage industry, there's been a notable rise in the number of seniors choosing reverse mortgages, reflecting both an increasing need and growing acceptance for this financial option. And in Canada, the reverse mortgage market has reached an impressive milestone. It's exceeded over $6 billion, and we're seeing month-over-month growth from January to today. This growth highlights the significance of reverse mortgage as a viable financial solution for seniors. So I'll just spend a minute talking about what a reverse mortgage is. And a reverse mortgage works by allowing homeowners aged 55 years and older access to borrow against that equity in their homes, providing them with tax-free cash without the requirement of having to make regular mortgage payments, improving their cash flow. So instead, the loan, along with the accrued interest, is only due when the homeowner moves out, sells the property, or passes away. So this financial tool is becoming increasingly more popular as it offers seniors a way to access the equity that they built up in their homes over the years, providing them with additional funds to enhance their retirement income and cover some of the healthcare costs, or even assist with their families financially, all while continuing to live in and retain ownership of their home. So that's it for now, folks. If I'm Dwayne Kavanagh, I'm a licensed mortgage agent in here on Ontario, Canada. And if you're a senior looking to explore options and interested in learning more about how a reverse mortgage could enhance your retirement lifestyle, let's talk. I'm here to help guide you through the whole process and help you to understand if a reverse mortgage is the right choice for you. That's it. Bye for now.